Good morning to everyone, and thanks for joining us in today's second quarter Tecnoglass results. We're very excited to report again another record quarter in pretty much all financial metrics, starting from top line down to gross profit, adjusted EBITDA, net income, EPS, leverage. Everything was beyond what we had planned for this quarter. Despite all the uncertainty out there, the markets continue to perform very well for us, and we continue to execute our strategy. We'll go into detail for each metric, but as you can see, revenues were up roughly 40% year over year, all organic, led by US residential, which continues to perform extremely well, up 86% year over year. We'll discuss residential in greater detail, but a lot of that is repair and remodeling as opposed to new construction, which is closely correlated with mortgage rates, which, as you all know, have gone up because of the Fed decisions as of late, but that is not impacting our business, as we'll discuss farther down the line. Record adjusted EBITDA, $54.6 million or 32% EBITDA margin. It was well beyond what we had budgeted internally. And again, the outperformance came from increased activity in the single family residential space, which now accounts for about 47% of our business on an LTM basis. EPS, 70 cents per share against 42 cents per share the previous year quarter, in line with basically what we've been saying. The revenues were up, margins clearly outperformed what we had expected, and as a result, we ended up outperforming from an EPS perspective as well. So let's go to the backlog. We are actually seeing the continued trend that we have been seeing in the previous quarters and years, with backlog up roughly 20% year over year, and also sequentially. And the reason for the backlog improvement is that commercial construction continues to be in a major rebound after being at a pause for about 18 months due to everything related to COVID. But now we're seeing a lot of projects come back. Ones that were put on hold are resuming activities. New permits are being put in place and new projects breaking ground, and that translates into incremental backlog for us. 96% of that backlog comes from the US, which continues to be by and large our main market, and basically the market with whom we're basically tying up our strategy to continue growing farther down the line. Moving on to the residential side of the business, 47% of total LTM revenues are now related to single family residential, which continues to grow rapidly. And we're expecting that the rest of the year, the upside on top line should continue to come from that, because on the commercial side, we already know what's scheduled and we know what should be invoiced the rest of the way. It is important to touch on this, and we wanted to make it clear that 65 to 70% of our business in the single family residential space is related to repair and remodeling, with the remaining part being new construction. So we are not as tightly correlated with interest rates and mortgage rates as some other businesses, such as home builders or whatnot. The R&R segment is very resilient. It can be counter-cyclical, and this is also being aided by the fact that there was a new regulation, our new tax regulation put in place in the state of Florida, where there is a sales tax waiver for the next 24 months for anybody that invests in hurricane-resistant glass and windows, which we see clearly as a tailwind to the business going forward. Moving on to our structural advantages and strategy. We have been touching on this because our situation is a little bit different than most of our US peers, in the sense that we are fully vertically integrated and have been able to maintain lead times. We have not had any issues with labor, obtaining labor and being able to hire employees as we grow. Our dynamics are different in Colombia, where we have our manufacturing plant. Unemployment rate is north of 11%. So we're not seeing the same macro dynamics in labor constraints or wage inflation as we are seeing in the US. So that's putting us in a strong position to continue gaining market share as we have been able to maintain lead times and have been able to have access to quality labor to continue growing our operation. In other fronts, such as energy and transportation, our dynamics are different as well. We obtain a lot of the energy that we need from cogeneration and solar panels, so we have not had the same type of sensibility to higher energy prices as some of our peers have had in the past. So going back to what we talked about on the revenue front, residential continues to lead the way, but there's also another important fact, and is that from a geographical perspective, if we think about this, the Southeast is enjoying some secular trends and some demographic trends that are making this geography outperform some others in the US. There's a lot of people moving down south to Miami, to Florida. There are companies that are relocating, and that continues to play well for what we're doing. Revenues, we hit a record revenue quarter, and July was actually a record quarter, even beyond what we saw in the second Q. So we think that we are well positioned to continue growing, and as a result, we have updated guidance as we'll discuss further. Commercial construction is also gaining momentum, growing 15% year over year. So right now we feel that we are in a situation where both segments are clicking at the right time. Adjusted EBITDA was at a record level. We were able to obviously gain some operating leverage on higher revenues as we continue to make a push on the single family residential segment. The margins look better because there's no installation work associated with that. We have benefited from all of the automation initiatives that were put in place last year, which are fully operational right now. So there are different dynamics that played a part in how profitable the company was in Q2 and what we expect going forward. From a leverage perspective, more of the same. We continue to delever based on how the adjusted EBITDA continues to grow and how we have paid down debt. So we're very well positioned and with a lot of liquidity and flexibility to execute on our strategy, continue to reinvest in growth CapEx, and take advantage of opportunities as they come along. Finally, as it relates to everything that we just discussed, we are updating our guidance, now going from 620 to 640 million in revenues, which equates to about a 27% organic growth year over year performance. And from an adjusted EBITDA, we're moving to 208 to 220 million, which at the midpoint of that equates to 44% growth year over year. Very strong results. We continue to be very optimistic about the remainder of the year and the rest of the way. So with that, I'll leave you, and I hope you join us for Q3 again. Thank you.